Welcome to the Derif Academy. In today's lesson, we'll explore the intermarket relationship between the Forex and stock markets. Understanding this connection can provide valuable insights for your trading strategy, allowing you to anticipate currency movements based on stock market performance. Intermarket analysis is a powerful tool for traders and investors, helping to predict market movements by examining correlations, lead-lag relationships, and the impact of macroeconomic factors. Let's dive into the relationship between Forex and the stock market. To grasp their relationship, it's essential to recognize the fundamental differences and dynamics of these markets. The Forex market is primarily driven by factors such as interest rates, geopolitical events, and trade balances. These influences stem largely from macroeconomic fundamentals and central bank policies. In contrast, the stock market is primarily shaped by company earnings, sector performance, investor sentiment, and broader economic indicators. Despite these differences, the two markets are deeply interconnected. Movements in one can often predict or influence movements in the other, creating both opportunities and risks for traders. Let's explore some of the most significant correlations between the Forex and stock markets. One of the most significant relationships is between the US dollar and US equities. Historically, the USD often shows an inverse correlation with US stock indices. When US stocks rise, signaling increased investor confidence, the USD may weaken as capital shifts to riskier assets. Conversely, in times of market stress, the USD tends to strengthen as a safe haven asset, reflecting a risk-off environment. Another important relationship is between the Japanese yen and global stock markets, especially during periods of risk aversion. The yen often strengthens in times of global uncertainty, reinforcing its status as a safe haven currency, while equity markets, particularly in the US and Europe, tend to decline. Indeed, risk sentiment plays a crucial role in the relationship between Forex and the stock market. During periods of economic uncertainty or market volatility, investors typically flock to safe haven currencies like the USD, Swiss franc, and JPY. This behavior can lead to stronger safe haven currencies and weaker stock markets. For example, during the 2008 financial crisis or the early stages of the COVID-19 pandemic, stock markets around the world plummeted and investors sought refuge in safe haven currencies. The increased demand for these currencies strengthened them, even as global equities were in freefall. It's important to note that these correlations aren't static. They evolve based on economic cycles, central bank policies, and global events. Advanced traders use tools like correlation coefficients, regression analysis, and macroeconomic models to track these relationships in real time. Forex markets also often react more quickly to macroeconomic events due to their liquidity and 24-hour trading cycle. For instance, a surprise interest rate hike by the Federal Reserve might immediately strengthen the USD, with stock markets following by pricing in the impact on corporate earnings and borrowing costs. Conversely, movements in the stock market can signal future Forex trends. For example, a sustained rally in a country's stock market might attract foreign capital, leading to an appreciation of that country's currency as investors buy assets in the local currency. To navigate the dynamic relationship between the Forex and stock markets, consider implementing these targeted trading strategies. Safe haven strategies. Utilize sentiment indicators from the stock market, such as the volatility index or investor sentiment surveys, to gauge potential currency movements. If the VIX spikes, indicating increased market fear, you might consider shifting focus to safe haven currencies like the USD, JPY, and CHF. Interest rate differential. Focus on currency pairs with significant interest rate differentials. For instance, when the Federal Reserve raises interest rates, the USD often strengthens against lower yielding currencies like the JPY or Euro. By monitoring interest rate expectations, you can anticipate currency movements and capitalize on these shifts. Currency strength divergence. Identify divergences between currency strength and stock market performance. For instance, if a stock market is rallying but the associated currency isn't strengthening, this could indicate underlying weakness in the currency or external factors affecting it. This discrepancy can offer trading opportunities such as shorting the currency or looking for reversal signals in the stock market. It is essential to be mindful of the challenges that may arise when aligning Forex trading strategies with stock market movements. Diverging market conditions. Forex markets are generally more liquid than stock markets, which can lead to different reactions to the same economic data. Ensure your strategy accounts for these differences in liquidity. Correlation breakdown. Historical correlations between currency pairs and stock indices may break down, leading to unexpected market behavior. In summary, the dynamic intermarket relationship between Forex and the stock market is a vital aspect of trading. By analyzing stock market performance, traders can make more informed decisions about currency movements. Stay tuned for more lessons from Derif Academy, and happy trading.